Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, we are going to be doing a quick stock market update today. We're going to be looking at the SPY, which is our proxy for the S&P 500. We're going to be looking at the PCC, put the call ratio and the VIX. We're going to be doing a fair bit of classical analysis today on top of our Elliott wave analysis and looking at both the primary and alternate count for the US major indices. So essentially, we'll start with the Elliott wave count first, shall we? So I have a primary count and an alternate count, and both are a double zigzag. One has us complete here, about to move higher, and that's the alternate. And I'm giving the more bearish count here, the primary count, position of primary at least until we invalidate this price level here. So I'll just talk you through it. Believing that we topped in a primary wave 1 of a cycle wave 5 move higher back in January of this year, we are now in a primary degree sell-off, and that's why I'm favouring the idea of us moving significantly lower, as a wave 2 correction should, well, it doesn't have to, we've seen throughout this bull market, but it can come to 50 to 61.8% or lower, but it could be quite shallow as well. So far we're very close to retracing 50% of the move from the March 2020 low. So we may have done enough. So I do have an invalidation point for the way I've interpreted this count in the meantime, which is here at 417.42. We would have to reinterpret how we're looking at this count if that level breaks. But the way I've got it here would be incorrect at that moment. So I'm looking at a W here, a flat into an X, and I'm looking at a much larger Y wave to unfold, which I suspect will break this channel that we're currently in and accelerate lower because of the way that we are subdividing into a 1 and a 2, and the 3 should accelerate lower. Okay, so this count expects things to get progressively more worse, and for things to break down more violently. And I mean just thinking that we're in the primary wave 2 count and we haven't seen capitulation in the volume yet, we haven't really seen any bullish divergence on the daytime frame in the RSI near these lows, there's no sign yet that the market's really done selling off. I mean, it could be, but there's no really sign yet that it has reached those moments of capitulation, and at a primary degree correction I would expect to see that kind of capitulation. So, marry that up with whatever fundamental analysis you like. There's a war going on in Europe, there's food shortages, there's still high inflation, that we're in the middle of a rate rising cycle, monetary tightening cycle. A lot of the real carnage which could ensue from these world events and monetary policies, I don't think has really unravelled yet. So it could progressively get worse from here. However, there is also evidence that we may have bottomed, so that's why we have invalidation points, and that's why we have an alternate count. So from this point, W, X, and then this subdividing as another zigzag with the A complete, the B wave in, and now a 1 and a 2 that's currently underway. Now, inside of this regression channel here, we could see this wave 2 come back to anywhere within 99.9% of this wave 1 down here. So if we just get a fib for a minute and we measure this thing, and come down to the low, we can see that we came back to 50%, right here, 50% retracement, and the median line of the channel, and that's where our resistance was for this initial move up. So seeing this as 5 waves, 1, 2, 3, 4, 5, up into an A, down into a B, and now what will be 5 waves up into a C, perhaps into the 61.8, or perhaps even up to the top of the channel below the 100% retracement here at 417.42, and then rolling over and heading lower in a 3, which should be aggressive enough to break pretty much all of this channeling structure that we've seen if this count is correct. So we'll just bring up an extra couple of support Fibonacci levels here. We've got the 786 and we've got the 89% retracement here, which could bring us pretty much back up to the top of the channel. We could come to here, still inside of the high, and then roll over and really start to accelerate down, and that's one way of looking at it. If we do break this level at 417.42, then the idea of this, at least this bit of the count, an impulse down and a retracement back, that's incorrect. Whether or not this could be part of some other structure before another zigzag, we'd have to reassess at that point, but If that gets broken, then the idea of this being an impulsive 1, 2 and 3 down is incorrect. So that's our invalidation point for the moment. Now if we come in and have a look at the alternate count, all I've done is taken this 5-wave move down here, and rather than looking at it as an acceleration of another 5 waves, 1, A, B, C, 2 into 3, I'm simply looking at it as the C of the Y. Okay, so we've gone A, B, C, W, A, B, C flat into X, A, B and shorter C into Y, but the C expands beyond the A, beyond where the A completes, and does complete and subdivide as a 5-wave impulse, so it is sufficient to say that we've bottomed here. So in this scenario, what we don't want to see is the price to come back to a new low, so let's just mark an invalidation point here. I'll put our little price, this is supposed to be 362.16, like so. Now this gives us a relatively tight little range between these two highs here to confirm or invalidate the counts. So we'll just say bullish invalidation point. Right, so if we come back through this level, the idea of having put in a low and completed this structure is incorrect, and we'd be looking at this 5-wave move into an A instead as a 5-wave move into a 1 and then a 2, and then we should accelerate 3, 4, 5, break this high to get a larger 1 back into a 2 and start moving off to a new all-time high. You know, having completed what would be primary wave 2 down here, 1 into 2, and then off we go. That's the Elliott wave picture, so let's just grab those for a moment and throw them into this alternate count, and we'll quickly recap. So from the primary wave 1 high, we've got either W, X, Y, and we've started the 1, we've completed the 1, and are in the wave 2 of the C of the Y. Looking to accelerate lower, and if I take another piece of geometry to show you here that I think supports the idea that it will accelerate, using the pitchfork instead of the regression channel here, we can see how an ABC back to the top of the pitchfork again would be resistance as it was here, as it was here, as it was here, and this would support the idea of there being plenty of room to aggressively move down into a 3. Okay, and then retrace into a 4 and then push down again lower in a 5, and we're going to get this extension you know, in the C. Now, some people have been asking me, why aren't you looking at this as an impulse? You know, if you're expecting an aggressive move down, and it's because it doesn't count as one. I mean, I literally can't say it simpler than that. If this is our first pivot here, this would have to be 5 waves, and it isn't. Right? There's just no way it's 5 waves. It's 1, 2, and 3, right? And then 1, 2, and 3. Right? We'd have to force a truncation in here and say that's your truncation there to get 5 waves. Truncations are pretty rare occurrences, and after such a strong move down, one wouldn't expect to see a truncation here. You know, there was no weakening momentum here. This was actually quite an aggressive sell-off, so a completed ABC makes sense here. And then this is a flat, and then this here subdivides as an impulse into a correction into another impulse. Now we considered the possibility of it being a diagonal, right? That's a backup count that we have here that we discussed on the NASDAQ as well, where we can say 1, 2, 3, 1, 1, 2, 3, 2, 1, 2, 3, 3, 1, 2, 3, 4, 1, 2, 3, 5. I should be saying ABC rather than 1, 2, 3, of course, but you get the point. Here we have a truncation in the 5th, short of falling short of the 3, and then we have a truncation in the actual C of the ABC of the 5th, which is also, it's just truncations piled on top of truncations, and I'm just not really happy with that as an idea. I see that quite clearly as 3, and I'm looking at this as 3 also. So this is a double zigzag pattern. Now if you disagree, that's fine. You could perhaps, if we come to the necessary targets, there's the possibility that we could look at it as an expanding diagonal. So we could say 1, 2, 3 to here, okay, and then we'd have to say, well actually no we can't, excuse me, we'd have to say 1, 2, 3 to here, using that truncation in the 4th and the 5th. We'd have to somehow get this free wave move to subdivide as an impulse, which it doesn't want to. And then we could finally got a zigzag for a 2, and this is 1 and this is 2. This is 3 to here, and you're going to get some kind of expanding pattern. Right. I don't like that either, because we have to force all these ugly truncations into the count. So for me, it is a zigzag and a zigzag with the potential to have bottomed here inside of a channel and move higher, which we have our alternate count for, or it's going to get progressively worse. If we come back above this level, we can have confidence in the alternate count and we can flip them over. However, if we break the previous low in the alternate count, here at 362.16, we can have confidence in the bearish count that we have completed a correction here and are now heading lower. So there you go. That's the Elliott wave count as I see it thus far. Okay, so now let's come out and do some classical analysis for the minute. We'll come out to the day time frame here and we'll look at some levels. So first thing I want to look at is some basic support and resistance, right? So let's say we're not done selling off. We haven't bottomed here as the alternate count suggests. And we're going to continue to go lower. So what can we look for below us? So, okay, essentially here I've got a bunch of levels. So I'm making a few assumptions here, admittedly. In this volume node here, where I've got all this demand, in this demand zone here, you've got these prior sell-offs on the way up, right, which both found buyers. So we came to resistance, sold off, back-tested prior resistance, which became support, found buyers, came back up towards the resistance, sold off, came back to support, back tested again, found buyers, moved to a new level and advanced. So there's demand in here, right? Previous buyers, well, will likely be buyers waiting here again. We have previous supports here, which later became resistance, which later became support. This level here, 323 spot 32, very significant. We have another level here of prior resistance, also going forward in time becoming support, right? So this is another significant level. Haven't labelled that, but if we come through this zone we can look to that support. It's around 301 on the SPY. Now bracketing this level here between the 359.09 and the 323 spot 32 is the 61.8% retracement here, 318 spot 24, and the 50% retracement 349.12. So there's a whole bunch of confluence sat in here. Right, whole bunch of confluence support levels sat in here. So if we do come down, whether it's that's one zigzag, this is a zigzag, this is another zigzag, and maybe it's not done, and we come into here. Or maybe we go 1, 2, 3, 4, and 5 down to a lower level, and we get a bigger sell-off. Right, these are both possible, but I would expect to find support in these levels down here somewhere. Now, if we just take that pitchfork back for a minute, we can see how if we continue to trend down, let's say we do get more aggressive, so we go up to the top of the pitchfork, we rush down to the bottom, we consolidate sideways, we come down again, we could easily come through these support levels to find something lower, or we could stop at any time during it. Okay, but you can see that the median line of the pitchfork goes through this support here, goes through the 50 here, goes through this support here, and the 61.8 here. You could work your way down through these levels till you find something to bounce off. Okay, so we've got a lot of confluence support down here. If we come out to the weekly time frame for a minute, I just want to back off a little bit so I can have a look at the weekly candle. And let's bring up our moving averages here as well. So turn off the support and resistance. Also in this same zone, we've got the 250 weekly moving average. Now, we last broke it during the March 2020 lows on the weekly time frame. We haven't broken that since the lows of 2011, and we were in the process of moving up through it from the 2008 GFC collapse of the economy, moving up to test it, back and through it, back test it and on. So we did that here in the COVID crash. We're still a fair ways off of it currently. You know, we could break it again and do something similar, or we could operate as support. Either way, it's in all of this same zone. So it's coming up to meet us in the demand zone here, which itself is bracketed between the 50 and the 61.8% Fibonacci retracement zones, in amongst all these price supports, assuming supports which were prior resistance. So there's just a lot down here, right, to get in the way of sellers, to get in the way of the bears. And we would be really coming back to some kind of essential market structure in here, right, as opposed to this blow off move where there was basically very thin trading until we get to the top, where you can see the most of the volume in the volume profile. This is only taken from the March 2020 lows. If you look at the longer term profile, then you'll obviously see, let's just pop it on here for a minute, you'll see much thicker trading down here than you will at the top. Okay, this is what I'm talking about. All of this is demand on a larger scale, all down here. We've got demand here around this correction, which I pointed out with my support and resistance level, but we've got a lot down here at significantly lower levels. Now I have got lower supports just in case we have an absolute meltdown. I've got supports all the way back to the top of the 2000 from the 2000 peak, .com peak, GFC peak. That's resistance, that would become support. That's down here in this huge demand zone, right, of all this prior trading. Let's just let the volume profile adjust here. Then we've got the peaks of resistance, which should become support around the 2015 highs. Okay, then up to the area we're in now, which is all this sideways trading we've got going on here. And then above that are local levels of support and resistance that we've just been discussing. So I've got it mapped out all the way down. Now I'm not suggesting it's going to get that bad, not at all. It could, and if it were to get that bad, then we'd have to see what, I mean, if this next wave were to subdivide as an impulse, that is going to basically make interpreting this as anything other than a series of zigzags very, very difficult, because we don't have a clear 5-wave impulse from the high. So I'd need to come in and have a big rethink. Maybe it could even be that expanding pattern, right? The idea that it's going to be some kind of gigantic leading, expanding diagonal in an A, but I spoke about all the different truncations we'd have to deal with to make that happen, so not a big fan. Suffice to say, in the meantime, bunch of support below us, bunch of confluent levels in Fibonacci, bunch of prior market structure, bunch of thicker trading down here, and serious support and resistance levels that have been prior tested, all waiting for us down here. Okay, so now let's turn all that off, and now let's have a look at our indicators. So weekly indicators first. There is some slight divergence on the weekly RSI between these levels here. Okay, now this is the most oversold we've been since the March 2020 sell-off, and we've gone from overbought to oversold, and there is a little bit of weekly divergence, not as strong as daily divergence as a predictor. Okay, OBV continues to trend lower, so does the MACD. Not a very pretty picture. Now let's come into the daily time frame, and we can see how there's some divergence in the MACD here, but there's none in the OBV and there's none in the RSI, which is lower lows. You could point to this being divergence in the RSI, but I think that's a little disingenuous. Let me explain why. That was a local divergence before a correction to a lower high. Here's these two lows here. Here's the divergence between those levels here in the RSI. That was heralding a return to a lower high on a larger time frame here. So this moved down, and then this moved back to a lower high. That's what that divergence was there for. We came back to an overbought condition, oversold, neutral, oversold. So it feels to me like that is not really related to the current lows. It is technically still divergence, because this is a low and this is a higher low, this is a low and a lower low, so maybe it'll play out, but I feel that was a local event signalling this move back. So nothing in our indicators really to signify a real dominant low being in place. Not like when we saw here in the March 2020 collapse. There was a very significant build-up of bullish divergence as we headed into the lows. See, low, high, low, high, low. and this was all drawing from back here, right? So you had all of that was higher lows in the RSI, lower lows in price. It's all well and good going, oh, there's divergence, yeah, but the vast majority of the collapse came during the divergence, so not really a signal that you should have been buying at any time. So the extreme in the OBV was the low, the extreme in the MACD was the low, the RSI was leading us by the nose, giving us higher lows all the way through this, but it was a strong example of divergence. Right? No such divergence on the daily time frame currently exists in the shorter term. Okay, so we'll wait for a couple of weeks. If we take out that high we spoke about, we can't have 1-2 down. If we take out the low, recent low, we can't have 1-2 up. We really are at the moment just stuck between inside of this little bracket, waiting to see what happens with the price action, and we'll see. Sure enough, or sorry, I should say that bracket there, excuse me, because this is 1 down, 2 back up. Sorry, I got a bit confused there. So here's the little bracket we're looking at the moment. Break back out of this level, we can have more confidence that the market has put in a low here. Right? Fail at this prior resistance and get rejected and take out a new low, we can have confidence that the bearish count is the correct one. Okay. Let's just tidy those up. So now let's come in and have a look at... Oh, we haven't looked at the volume. So this is another feature. So, very orderly sell-off so far. Let me just get rid of the indicators. So, we've had panic, so we'll come and look at the PCC and the VIX in a minute. This is the volume during the lows of March 2020 low, volume picking up here, volume picking up here. Now, obviously, easier to trade multiple units of the SPY when the price is at $218 as opposed to being at $364, right? So volume will be higher in these lower lows. So perhaps we should look at it as relative to prior trading. Right? Here's prior trading range, here's prior trading range. In this example so far, we haven't really seen a massive increase in volume. Right? It's a slight increase and it's been declining. It really isn't all that exceptional, even though price is at almost a 50% discount from this low here. So no real sign of capitulation event, just an orderly sell-off. An orderly sell-off could be just that, 1 into 2, or it could be something preceding something getting really ugly. Okay, if something breaks down and proceeds to get worse. So, on that note, let's now come over and have a look at the PCC here using our 60 EMA and our 250 EMA. We set up this little range of what I call extreme fear and panic to extreme greed and complacency. So we have this descending trend line, and each of these, if I just bring up the SPY for a minute, I bring up my VIX and PCC extremes, going back through prior, I did have some listed here, I don't know why I've moved them, but if we look at the biggest events, March 2020, taper temper 2000, taper tantrum 2018, the power pivot was here, February 2018, that was the taper tantrum, sorry, that was the power pivot, 2015, 2011, marking out, the green marking out our VIX extremes and the yellows marking out our PCC extremes. They are all the market lows. Right? Each time the market bottomed, we reached extremes here, 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 and perhaps here. Right? That's the one we don't know about yet because that's the current one. So we've come to this downward trend line of these prior market lows. If this is a low, we should start the reverse and head back down. Now this is normally a long process. I mean, we've got from 2018 January to the lows of February 21, so over a year. Well, this is 2019, sorry, so we've got over 2 years of movement down here, so this could be a couple of years of the market levitating again, going to new highs, gradually getting greedier and greedier. Now, even at the lows here of extreme greed and complacency, right, the market continued to climb as fear started to climb with it. We did not reach the top until, where are we? Till here. Right, so we had all of this increasing here as well for another year almost before the market topped out. So that could buy you a lot of time, right, before you start to have another major high and then a sell-off. So the question really is it a cycle wave top, in which case I feel that this trend line will not be respected and we will have an explosion. Things will get really nasty. Or is it 1 and 2 and then we're going to come down and have a whole 3 years or perhaps longer of the market levitating higher to new levels before we finally reach the high. So interesting to see whether this rolls over or not over the next few weeks. If this starts to decline, right, and price takes out the highs we spoke about, good chance that that was a bottom, right? Just like this, just like this, just like this, just like this, just like this. There's a good chance it was a bottom. Now let's have a look at the VIX. Interesting again, the orderliness of the sell-off. Right, we've had some pretty extreme readings in the past. GFC, COVID, and then a whole bunch. There's August 15. There's the taper tantrum. There's the Powell pivot. Right, here's 2011. This was the double dip recession that everyone was expecting us to result in a further collapse, the continuation of the great financial crisis. The economy was not going to recover, and there was a lot of pessimism that we were going into some kind of depression or extended recession. So we're not back into any of those levels yet. Right? We're currently trading all the way down here, 26.71 in the VIX, which is really not that elevated relative to these prior events. Considering it's a 50% sell-off of the move up from the March low, I think overall it represents... It's over 20%, isn't it? It's 24% the market sold off now. That's a significant decline to lose a quarter of the United States, corporation wealth, a value essentially. Market cap has collapsed by a quarter, and yet everything looks pretty tame. PCC is getting extreme, but the VIX is still looking pretty stable. Now I have noticed a compression pattern going on here. I don't believe you can get an Elliott wave count in the VIX at all, as in a continuous Elliott wave count, as in an impulse up or down on a larger time frame, but I do believe Elliott wave structures can appear independently because they are trading structures, aren't they? They are compression patterns. We see this in these descending patterns all the time in the VIX. Okay, and now we've got a little contracting triangle going on here. So like this. So perhaps this is a sign that we're about to get a pop. Right, we're squeezing the VIX and we're going to get a pop perhaps back into this territory. Right. So we're at a bit of an inflection point. Market is still managing the process at the moment. It's managing the sell-off. It's gradually grinding away and discounting. However, it could all break down very violently, very quickly, and you could end up with another one of these events. Okay. That supports the idea of accelerating down into a 3, 4 and 5 of a larger zigzag. Or we could just continue an orderly sell-off. Or we've found the bottom. It's just, I find it peculiar that the VIX is just so suppressed at the moment. Yeah, but it is what it is. Alright then guys, we've looked at everything now I think. So coming back to the SPY, to sum up, we're just looking for, in the short term at least, let's come back to the 4 hour, bring back our primary. In the short term, we're looking to see if this level at 417.42, if this is respected, if price comes back. We know that this is a median line and the 50% fib, this is roughly the 61.8. Do we come into here, maybe to the channel, and do we get rejection? If we break this price here, we can start to look at this as an impulse. Now at which point we're going to want to see the 3, this is 1, this is 2, we're going to want to see the 3 start to hit extensions that we would expect for the impulse. 1618, 161, my brain's melting, excuse me, 1618, isn't it? That's it. Let's just put up the 3 wave extension here. So 1618 would be here, 2618 up here. So if we get a really strong impulse, then it's more likely 1, 2, 3 rather than A, B, C, and we're going higher. On the flip side of that, break the prior low at 362.16, and that's bullish invalidation, and this is not 1 and 2, this is 1 and 2, and we're going lower. Alright guys, thank you very much for joining me on this technical analysis of the Spy, PCC and the VIX. If you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below, and always a huge thank you to my Patreon subscribers. Your support is greatly appreciated, and I'll be back with you guys later in the week. All the best, bye bye.